Welcome to the last roundtable of this 8th International Risk Management Conference. I'm very happy to be here and present this professional workshop because I think it's a nice way to round out all the discussions that we had for the last 2 days and all the presentations. And as a tradition of this conference, we always have a professional workshop to have a series of practitioners to walk through not only what is relevant from an academic and theoretical point of view, but also what is relevant from a practitioner's point of view. And we are very lucky here because we have a good panel and a very good mix of CROs and experts that they are involved actively every day in managing some of the risks that we discussed during the conference. And this is why we decided to leave a title to this panel as the same as of the conference. So the new risk management paradigm, how investment, financial stability and regulation will shape the European and global financial markets. Somebody say it looks like you took some of the keywords and just put it together, try to make a sense of it. Like a puzzle of the keywords or the key themes that they are surrounding us, especially in Europe. In reality, I think I expect that this panel will deliver a lot in terms of providing some comfort that these different objectives that is, I think, that described in the titles in terms of the financial stability is required to the markets, the fact that in Europe we need a push for growth, and also the fact that we are immersed in a growing amounts of regulation. I think it's important from a risk management perspective. We can hear from the people that are daily working on these aspects and trying to find and learn some lessons. So I will introduce now briefly our panelists, and then I will introduce a bit more deeply just to have them start talking, and I will ask some specific points to discuss with us. So we have, starting from your left, we have Sergio Scandizzo from European Investment Bank, we have John Nurst from European Investment Fund, we have Francesca Campolongo from the Joint Research Center of the European Commission, Peter Harlow from the European Stability Mechanism, and Dominique Blanchard from the Luxembourg Risk Management Association, and also is a consultancy firm, and then we have Giuseppe Lusignani from the University of Bologna and Prometea, our main sponsor. So I think I will start with Francesca. I think there is a giveaway on the slide here. And I think it's important, and I think the point where I would like to start is that, especially after the discussion that we had before with Professor Hartmann and Klaus Regli, I think it could be interesting to have a bit more understanding of where we are in Europe in terms of legislation, how everything that we have discussed until now, there's reforms, markets, capital markets union, etc. They are pretty much built in terms of a system that is going to enable us to keep financial stability and promote growth. So I will leave to Francesca to start with her presentation.
Okay. Thank you, Cosimo. So the idea is, in these few minutes of my presentation, I would like to talk about the regulation and legislation that the European Commission has put forward in this past year of the crisis in order to make our banking system more resilient to shock, in order to make it capable to absorb potential future shocks that may arrive. And of course I will try to discuss what are the good things, the progresses that I believe we made, but I will also focus on some areas that still require work to be done and that could potentially still have some open issues. So, of course, I will go here to a list of recent legislation proposed by the European Commission that is aimed at tackling systemic risk. Of course, the list is not exhaustive because there are also other proposals, but the choice here is based on the idea of showing those proposals where we, as Joint Research Center of the European Commission, have contributed. Because the Joint Research Center of the Commission is providing scientific studies and analysis to the policymakers in Brussels in order to have policies that are based on some scientific evidence. And these are the Commission regulation and directives, where we have provided some scientific analysis. So the first thing I would like to mention is the revision of the directive for deposit guarantee scheme. I believe that the issue of deposit protection is extremely important because, of course, when we have a bank that is in default, it's important for the people who hold bank accounts to know that they will be protected, their deposits will be protected in case of bank failures. And during the crisis, there was a problem of having a largely heterogeneous situation for the functioning of these deposit protection schemes in the different member countries. And this is not acceptable because, especially of the cross-border banks, we need to have an harmonized legislation. So a major step forward was this harmonization of the functioning of deposit protection in the EU countries, and also an increased level of protection, because now banks' deposits are protected up to 100,000, which is a major achievement in terms of reassuring people and avoiding panic, which could spread and lead to bank runs. So this is an important progress to make our banking system more resilient to shock. Then there is all the regulation on capital requirements. This is the response at European level of the new global standards for capital as introduced by Basel III. In Europe we have a regulation and a directive, which is making our banks more robust in terms of capital and liquidity requirements. We have better capitalized banks with a higher level of capitals, but also better quality of capital, and also requirements for liquidity in order to be able to absorb shocks and liquidity shocks. Then we have, this was also mentioned by Klaus Regli, the framework for bank recovery and resolution, the directive, which is basically setting common rules for resolving banks that are failing. This is important because we have to let the bank fail. We cannot say that we will save all the banks. But we have to have a clear set of rules which has to be harmonized, because national authorities can then cooperate effectively and also resolve in an orderly manner banks which are cross-border. So we can address cross-border banking crisis. And also here we have the important introduction of the bail-in. So not only we have harmonized tools, but also tools that are more effective, because the bail-in is an important step forward. Then there is the proposal that has been put forward by the Commission for reforming the banking structure. But this is still a proposal, because it's currently at the negotiation of Council and Parliament, but it has not yet been approved. The idea is that there are banks that are, of course, very big, that are also involved in trading activities that are potentially very risky. And the idea is to give the powers to the supervisors to ask those banks to separate the potentially risky trading activities from the deposit-taking functions that is essential for the economy. And in my view, if this proposal is to be approved, is a very major step in terms of increasing the capability to absorb future shocks, because it's very difficult to manage banks that are very big, large. And then, again, mentioned by Klaus Regli before, in the context of the banking union, we established not only a single supervisory mechanism, but also a single resolution mechanism with a single resolution fund, which is somehow complementing the Bank Recovery and Resolution Directive, because we are setting up a common fund to manage the failure of big banks in an orderly manner. Now, the Joint Research Center, as you can see, there are many pieces of legislation that have been put forward during the crisis. At the JRC, we have tried to quantify somehow the effect, the beneficial effects of all this regulation in terms of improving the resilience of our banking system. And to this goal, we have used a model that we have that is called Symbol, a Monte Carlo simulation model that estimates the distribution of losses that can be generated in the banking sector. And we have, you can see the 3 bars here are looking at different ways to absorb these losses that could be potentially generated by the banking sector. Each bar represents a different scenarios in terms of policy setting, so it represents different tools that can be available. In the first bar, we are in the condition of as of 2008 with Basel II. Then we look at what happens if we move in a scenario where we will also have the bail-in in place. And then the third bar, we are also considering the Basel III increased level of capital and the existence of the resolution fund. And okay, the overall amount of losses is the same, but what is different is the split. We can see that in the first bar, only a part was absorbed by the capital, and then the orange part is representing the amount of losses generated by the banking system that could potentially affect the public finances, the taxpayer money. And this is exactly the situation that we would like to avoid. And you can see how the introduction of the safety net tools is reducing this orange bar, so substantially, so basically increasing the resilience of the banking system in the sense of minimizing the likelihood of having a situation in which the public money has to be used to save the banks. Now, all this is very positive, but there are also some areas where we still need to work. I could go into the discussion of the implementation of all these regulations, because as usual the devil is in the detail. But I would rather make some general statement. And so the main comment that I would like to make is that, of course, regulation is always conceived and developed thinking of the past crisis, thinking of the past market failures, but then the situation evolves, is always evolving. So there is, first of all, a behavioral response to regulation, which implies that market will adapt and will change on the basis of the new regulation. And also, there is financial innovation, which is always a good thing in a sense because it can bring some benefits to the economy. There are like new forms of finance, like the crowdfunding, the digital currencies, but there are also potential threats and risks that are hidden and that need to be uncovered and potentially regulated. And that another important point is the linkages that exist among the financial sectors. A lot of regulation has been put in place to regulate the banking market, but then of course the risks may shift somewhere else. There is the contagion effect with pensions, insurance. We have introduced the bail-in, okay, but then who are the bank creditors? Maybe the bonds of the banks are held by pension funds or are held by insurance companies, so we're just shifting the risk somewhere else. Or we're shifting the risk in the shadow banking, which is not regulated as the traditional banking sector. So I think that for the future it's important to look into these areas. So my main message is, of course, systemic risk is complex. Several policy initiatives backed by scientific research have allowed to make good progresses in reducing systemic risk, but of course there is more work that needs to be done, especially for these new areas.
Thank you very much for this first intervention. What I forgot to say before, I think, and also I want to highlight also that Francesca Campolonga is a very prolific author, academic author, and when we set up the DRI into the ESM, there were a lot of contacts between the ESM and also DRC, because of their work is very important. And it was very important for us to set up this kind of tool that we introduced in our into the ESM. So thank you very much for the presentation. I think the theme here is really about the systemic risk and now what is the reaction from a policy perspective that we had. So maybe I think the best second speaker we can have is to start from financial stability. That maybe is the basis on which then we can progress in other areas of growth. Is Peter Harlow, who is Chief Risk Officer of the ESM, and since pretty much the Chief Risk Officer function was, the centralized risk function was created at the end of 2012, and he's been a CRO in other institutions for many years before, mainly based in London, and then he took this decision to move to Luxembourg, and I think he's going to be talking about, I think, the role of the ESM and also how risk is managed inside our institution. So I think I have to go to the presentation. That's a few slides. Please.
Yes. Thank you very much, Cosimo. Yes, I'm just going to talk very briefly about to the question of how we manage risk in what we might call a shock-absorbing institution or a crisis resolution mechanism such as the ESM. So if we could just have the first. Are you doing this or one minute?
Maybe
I can do this.
Okay.
That's fine. Okay. That's why I've got a deputy chief risk officer. Turn the slides for me. I think we've had quite a lot today on the ESM and also on the EFSF, and some of the slides I think overlap a little bit with what Klaus Regling said earlier, so I'll hopefully be able to move through them reasonably quickly. At the founding of the ESM in 2012, which, as you have heard, followed the setting up of the EFSF temporary facility at the height of the euro crisis in 2010, the main requirement regarding risk management was something that was central to all of the euro area finance ministers when they were talking about setting up the ESM, because they realized that this was going to be an institution that was not only going to be at the heart of the crisis, but also would have a really substantial amount of financial resources, and therefore they wanted to make sure that it was both protected and also that it was effective. So right at the beginning of the ESM, there was set up this thing called the high-level principles for risk management, which if you go onto the website you can read if you're interested. And this basically set up things, very, very traditional type of things for risk management, such as the 3 lines of defense governance model, with business as the first line, risk management as the second, and then audit as the third. It had a governance arrangements for risk committees. It set up the role of the chief risk officer and the risk department and what tasks they would do, and also set out the main taxonomy of different risk types. There's a risk appetite statement which was translating the mandate of the ESM into what that means in terms of risk parameters, and there's various other documents that accompany that, such as an investment policy for the paid-in capital. Also at the heart of it is this concept of risk culture, which is something that Cosimo and I are talking very actively about in the organisation, which is really just making sure that we have the highest ethical standards within the organisation, because reputational risk is absolutely key to an organisation like ours that is involved with such a large amount of financial resource. But also looking at the other principles that you might expect in risk culture about what individual staff roles have within risk management. And I think that together all of that is very much a, can we just go on to the next slide? Very much a traditional approach to risk management, but of course, as you might expect, it's not going to be just a simple copy of something like a bank risk management approach. And we've actually had quite a lot of difficulty in setting up the risk management function, because There are lots of examples, and particularly the Basel Accord, is, various different Basel rules, and the BIS have published lots of information about that, about how to manage risk and what kind of things to do. But they do apply very much specifically to banks. So what we've had to do is look at shaping that around the particular nature of the ESM. And also I should mention that we also have done the similar thing for the EFSF as well, because although, as Klaus correctly mentioned, the EFSF is a temporary facility that was only set up to operate at the outset for 3 years, and it's now closed to new lending. It still will continue for a very long time because the loans that it actually has lent out have very long life. So, but both of these organisations will continue on for some time. The first thing that I think is really sort of significantly different about the ESM is in the nature of credit risk, because, as it says on the first bullet point there, the country lending is the largest risk that we run by a long way, and you can see the numbers there, and Klaus gave them earlier. Very, very large amounts of money have been lent. But the actual risk management of these is not done by the risk department. It's not like, say, a multilateral development bank or even an ordinary commercial bank, in that the decision to lend to a country is made by the Board of Governors of the ESM, who are basically the finance ministers of the euro area countries, so there's 19 of them. And that effectively creates an unusual situation for us in that we don't have the same kind of emphasis on credit risk as you might expect, even though the loans are actually the most significant risk that we run, because the country risk that is taken on is something that we as a risk department have no control over. It's something that is imposed upon us as part of the mandate of the ESM and the EFSF. But if you take that to one side, then the other aspects of risk management are very typical of classical risk management, such as we have paid-in capital, so we have to invest that, and we've got risk management parameters around that, which we have to run with. Asset liability mismatch between the funding that we do, as Klaus mentioned, we borrow from in the private market. And so we have to manage our asset liability profile. So we have a kind of mixture of some things which are typical and some things which are not. And Klaus also mentioned the fact that the ESM is set up under public international law, which then creates another difficulty for us, because everything that we do has actually got to be defined within law, rather than just simply relying on a standard jurisdiction that might occur within an individual country or even within the European Union. We have small staff numbers, but we have a very large financial footprint. So we have to think very carefully about those aspects, and we have to think about the fact that the ESM is set up on the basis of an organisation with paid-in capital and callable capital, whereas the EFSF was set up, as Klaus mentioned, very quickly, and the easiest way to set it up was to set it up by government guarantees. So it's very much a kind of mixture of tailored governance, and we have to think very much around scenario analysis, which I'll come back to in a second. So on the final slide then, just looking at some of the key risk management aspects to ensure that our institutions remain strong and able to fulfill their mandate. And the first thing to mention is the fact that we've basically set up a high credit quality by design. Essentially, I think one of the reasons why the EFSF and ESM have succeeded in this crisis resolution mandate that they were given is because it transferred the problem from just an individual country to the whole of the euro area. And I think as one can imagine, although it's quite possible for an individual country to run into difficulties and to lose access to market, the whole of the euro area is easily bigger than any speculation that the markets can undertake. So essentially, when we are borrowing in the market, we are borrowing with the same kind of credit as the euro area as a whole. We have also a very strong capital base. We have 80 billion of paid-in capital and 620 billion of callable capital behind that, which is easily enough to cover all of the combined lending capacity of ESM and EFSF. Another area where we've had to be very careful, as I mentioned earlier, is in our kind of our actual treaty-based mandate, because everything is defined in a treaty that sets up the ESM. So the importance to us of the legal framework is that we have to make sure that that everything is very carefully understood, and all the kind of the details of the legal framework are always investigated and understood, because if it's not firm within the legal framework, then potentially there could be some challenge. As you may have heard, we did have some challenge from, say, the German Constitutional Court over the legality of the ESM, but that was passed through last year. We also have to keep very much in contact with political and economic developments, and as was mentioned earlier, not least in this current time around the situation with Greece, but it's also true that there are other things that affect us as well as we're looking forward to future crises potentially. Another area of importance to us is diversification. It's very important for us to be borrowing from the financial markets, so we don't just simply use public funds. We actually go out and borrow from the financial markets, so we issue bonds for both ESM and EFSF, and so we need to make sure that we have the widest possible access to investors to make sure that we can cover not only just our current loans, but also potentially, if we needed to do another program, say in a few years' time, that we'd be able to tap into a wide and broad investor base. And so we have set up benchmark issues. We've made sure that we plan the issuance as far as possible, and we have a very careful liquidity management approach. And on the investment side for our paid-in capital, we've also had to deal with the situation that occurs now within the euro area of low and even negative interest rates at the short end of the curve, and so we're expanding our ability to invest our capital to make sure that our capital is available and liquid for any eventualities. And also very important, as I mentioned just earlier, is the use of stress tests and scenario planning, because in any institution that is operating in this kind of stability support area, we need to be able to think of what might happen if other institutions weren't able to operate, or if indeed other countries have not been able to access the markets. And we kind of think of some kind of analogies. I think internally we've talked about the ESM as a kind of a fire engine, being able to always be ready to go and put out a fire. I prefer the lifeboat illustration, because I think it kind of gives that sense of having to go out in difficult conditions and still be able to operate. And so, from the point of view of designing the risk management function, we've got to think that some of the more traditional tools may not work, and therefore we have to think very much around the kind of scenarios and different possible eventualities that could occur. And that's part of the challenge and indeed the interest of working in the risk function there.
Thank you very much, Peter. And I think hopefully, it was very helpful to understand, what are the inner mechanism of the risk management into the ESM. And in terms, if you speak about mandates and roles into this European infrastructure, I think now it's most important to understand better how, for example, the EIB, EAF, they contribute to this, because in reality, if the ESM is like the firefighting institution or emergency one or stability, say, tool, the EIB and EAF, for sure, they are now the forefront of the support to growth, especially thanks to the Juncker plan and also the specific mandates that they had in the recent years. So I will start with Sergio Scandizzo, that is the head of model validation at the European Investment Bank here in Luxembourg. Again, another prolific writer and author on the fields of operational risk and modeling. And I think we leave the floor to him to tell us how the EIB will, how risk is measured EIB that will support the growth and ambitious plans.
For the next 10 minutes. The first thing I'd like to say is that the EIB is, as Cosimo said, at the forefront of the DIB group, is at the forefront of the Juncker plan, and it has undoubtedly a key role in it. But many people have talked about this role as something new to which the EIB needs to do some drastic adjustment in order to fulfill. And I would just starting with arguing that this, what the EIB is asked to do in relation to the Juncker plan, is very much in line with its original mission. The bank was set up in 1958 at a time where there were only 6 member states, and at a time, of course, of completely different political and economic environment, when the closer union was, let's not say a mirage, but certainly more of an idea than a reality. And at a time where there were substantial differences in development and in growth between different parts of Europe. And the role that it was set up to fulfill was very much to foster growth and economic cohesion by investing in projects favoring especially those that would not have been otherwise financed or realized without the EIB intervention. So that was very much the original idea, through, of course, the combined good faith of the member state who back the EIB and are the reason why we enjoy a top credit standing. So, let's say, philosophically, the concept of the Juncker plan is, I'm not going to say a variation on the theme, it's an evolution that is very much natural if you look at the history of the bank, and specifically at more recent history. After the financial crisis, in the immediate aftermath of the financial crisis, the bank was asked again to fulfill a similar role, but of course in different circumstances and by, let's say, responding to a specific requirements set out by the member states. We had to continue actually to increase our disbursement at a moment where the economic and funding conditions were such that calling them challenging is an understatement. And yet we had I believe it was the largest disbursement in EIB history in 2010. Where basically everybody else was reining in and trying to raise capital in order to be, let's say, to deal with the huge risk exposures that have been, let's say, exposed by the crisis. Later, not much later, but a couple of years later, during the Euro crisis, again, we were asked to continue to lend at a time where many member states had huge budget difficulties and were facing fiscal imbalances, some of which are haunting us to these days. So that is to me, so to speak, the general approach, the general envelope of this, the general idea. And when it comes to the specifics of the Juncker plan, as you probably know, it has 3 pillars: an investment fund, a mechanism for generating projects, and let's say an objective of simplifying and facilitating the investment environment throughout Europe. The EIB is, of course, pretty much concerned mainly by the first 2, but again, if you look at those 2, you still see the same fundamental components, like making investments viable and bankable, which would not have otherwise been without our intervention. So it is an instance of the same thing, but a very big instance to be sure, because I think I've read somewhere that the shortage of investments in Europe over the last 6 years is something around 430 billion. And therefore, the 350 billion that the plan should overall deliver are, let's say, definitely not an exaggeration in terms of objective. There is a lot of discussion, of course, about the multiplicator, this famous 1 to 15 leverage, whereas with 21 billion of guarantees, we can actually we can actually increase the overall size to 315. I don't want to minimize, I'm simply going to say that on a smaller scale, we have done even more than 1 to 15. And therefore, it is possible. What would make it really possible is a combination, in my view, of three things. So the bank will need to, of course, adjust its risk appetite, which is something that it has done in the past, in order to fulfill the requirements set out by the member state. The bank has to maintain its creditworthiness, because otherwise there is no point in trying to continue to fulfill this role. And of course, another thing that the bank has done systematically in the past and has to continue to do is to continue to select projects according to very high standards, because to create a pipeline of 300 billion projects in principle is easy. I mean, there is a lot of things that need to be built. But maximizing the benefit of this in such a way that it really creates a switch in confidence in the European market is what really is needed, so that in the end investment grow up by a lot more than 315 billion, because we need a lot more than 315 billion. How do we realize this? I mean, of course, if we show that we can select high-quality projects while at the same time, select high-quality projects that would have been left on the shelf if we hadn't intervened, while at the same time maintaining the standards that we are used to, I think that is the main contribution to that increase in confidence. One word about the creditworthiness. Some commentators say that the EIB group has a AAA fetish, meaning that we would do whatever to keep it. Now, when you are with something for a long time, you get used to it, of course, and you don't wish to lose it, especially if that something is good. But the real reason why we want to stick to it is because that is what, again, allows us to fulfill the original mission. As Dr. Redling was saying this morning, about the ESM passing the funding cost to the shareholders, to the borrowers, the EIB is built on a similar mechanism, and the only way that mechanism adds real value is if that advantage is real, and that is what the AAA is there for. One last thought about risk measurement and risk assessment, which you've asked. We are probably the only multilateral development bank that has a prudential risk framework which is entirely modeled around Basel II and Basel III. Therefore, at the same time, we try to have the same level of sophistication as the most advanced commercial banks, but this also gives us the same kind of constraint in our effort to be compliant with the best international practices. So that is what we certainly will continue to do, and will continue to do while adjusting to the requirements of the Juncker plan. We will continue to hire, because we will need more competence, especially competence in financial structures that are relatively new to us, or in which we do not have as much experience in certain others. We will keep hiring in terms of expertise in projects, which are the ones that we all know are needed: infrastructure, environment, innovation, SMEs. And we'll try to do so by maintaining the same internal control framework, because we will be under a lot of pressure, and it's when you are under a lot of pressure that you tend to make mistakes. So one might say this is a tight balancing act. We prefer to look at it as a recurring test of how well we can fulfill that original mission. Thank you.
Thank you very much. And I think also to address some of the potential questions that we have had after about operational risk, how you're going to implement also from that perspective this ambitious plan. And you touch base on aspect of rating, maintainers, and maybe the linked one of capital preservation, maybe something hot topic for some of our institutions. As you can see, we're moving a bit outside of the comfort. We move from a stability mechanism to the EIB, and now I think the next step is further out of the curve in terms of riskiness with the European Investment Fund, jobs now that we'll talk about, as we stand to the equity side, the role that the EIF has into the growth in Europe is being played, and also how they're planning to manage these aspects. John Nelson is Head of Risk Management and Compliance at the EIF, and has been recently appointed, and he had a long experience as a compliance risk management in other organizations. So I'll refer to him to talk a bit more about their role in the context of our...
So I would like first to say a word about the EIF as such, whereas it is an institution which is a bit more, less known within the IFI family. So we are indeed an affiliate of the European Investment Bank, but we are at the same time a public-private partnership, set up as a public-private partnership in 1994. And between this partnership between the EIB, the European Union, and a variety of financial institutions which range from national promotional banks to private banks. There are some differences between the EIB mission and ours, which has influenced the way which we act. First of all, we are a risk-taking institution. We are established to take risk. And this has, of course, an impact on the way we see risk and on the philosophy, how we address risk. Secondly, we have a profit goal. So we are not a non-for-profit organization. We are an organization which should have, which should show annual profit and also distributes dividends. Now, at the same time, we are not a bank. We are, well, something, let's say, an asset manager sui generis, because our funding, unlike EIB's funding, is not from the market. We do not issue bonds and things of that kind. We have our own capital, but mostly we are financed by third-party mandates. The biggest one coming from EIB itself, and then also from the European Union budget, but also from other sources, including private market sources. So the interesting way which you are guided by Cosimo in this panel is that it comes from very public to more and more private. You have a very hands-on contact with the market, and this comes from our activities to take risk vis-à-vis financial intermediaries, either by guarantees or by participation with private equity funds. Now, the Juncker plan is something which hits us within our within the strategic group, EIB group, as part of the responsibility of EIB to implement the Juncker plan, and it is basically focused on our mission to provide risk finance for the benefit of small and medium-sized enterprises. So it's corporate risk within the European Union, no project risk, no outside the European Union. And this complements the activities of EIB, which Sergio has just explained. Well, one word also from my side to this AAA. We have a very specific business model based on the AAA, because the guarantees which we issue, one of the business line, or specifically securitization and similar transactions, provides through the AAA capital release to our financial intermediaries, and they will have to undertake that they use the released capital in order to finance additional SME financing, which they otherwise would not have done. So therefore the AAA, which we share with EIB, is also extremely important for us. Again, as we do not use our own capital, it is sometimes a bit easier for us to maintain this, but nevertheless, it is an ongoing concern. And in this case, not just because we are used to it, but for very practical reasons of a business line which otherwise would have a severe problem. Now, talking about risk management, coming back to the fact that we are established as a risk-taking organization, I think that for us risk management has a bit another dimension than for a normal banking institution. For us, risk is something positive. It is part of our mission. We have to take risk. That is our raison d'être, if you want to. So it moves, in my view, from risk, classic risk management approach, very much to a quality approach, to assess the quality of the operations which we are following. And in the view of these upcoming challenges, Juncker Plan and I mean Juncker Plan, we must not forget, this is just something which is additional to the normal business growth we would have done anyway. So, or should be ideally. So there is a lot coming up to us. And what we have done is, first of all, we have put all the second line of defense together. We have regrouped risk management and compliance, which allows us to address risk management on a integrated, on a holistic level. And I may remind the EBA guideline on the internal structures or organization of banks, the guideline number 44, where in the beginning there's written that the lack of a holistic risk management approach was identified as one of the problems which led to the crisis 2008. We also share what we integrate into EIB's prudential risk framework, and we have developed a closer cooperation between both institutions in this context, in the prudential risk assessment. But at the end of the day, I think the whole situation right now raises some questions, and which will not be answered today, but which will be relevant over time. And this is the question, first of all, for me, what is the role of the IFIs? In the market perception, the IFIs, specifically EIB or EAF as well, we've counted that, have first of all deep pockets. Secondly, it's our role certainly to be a mediator between politics and the private market, and to get the private market on board for the political mission which we are following. But at the same time, the burden which is coming to us is fairly huge. First of all, is the lack of cash out of the EU budget in connection with the Juncker Plan. I mean, it's a guarantee, and well, the guarantee is no cash. So we have to get in advance in order to have the plan running. And secondly, what I think is to be thought about, it is fine to do volumes and it's fine to drive volumes, but over time, and we have seen that in our financing mandates for, let's say, less developed regions in the European Union, what counts at the time, at the end, is the absorption of the market by the volumes which we are creating. The structures are important, and long-term is the measurement of the impact of the financing which we are responsible to deploy in the market. I have no answer to that What we try to establish is a fairly robust internal organizational and a risk framework in order to counter this. Thank you.
Thank you very much for your input. I think it was very important also to finish this first part about what the institutions, institutions are doing. I would like now to pass the word also for some logistic problem of timing to Professor Lusignani. Professor Lusignani to talk about. Professor Lusignani is a professor of financial markets in the institutions at the University of Bologna, and he's also the deputy chairman of Prometea. That was also my main sponsor for this edition of the International Risk Management Conference. And I think, again, for him, the role, given his role as a professor academic, but also as an advisor and consultant to many important financial institutions, is to work through some of the challenges we discussed until now, and also to provide a little profile of Prometea. I think it's quite good.
A few words about. Can I? Yeah. Just a few words about Prometea, since many of you might not know. The Italian people know Prometea. Prometea is an institution that starts from the university, actually. So as a group of economics professors. So they start as a research institute. So we still provide analysis, macroeconomic analysis, and we forecast the Italian economy, the international economy. But now we have become, let's say, a financial consulting and economic research institute. We are more than 500 people, and we work around Europe, basically doing activity research and risk management consulting. Here you have our number of companies that are in the group. So Prometea is a non-profit organization, the associazione, that is on almost 50% of the Prometea group, the Prometea Consulting Limited Company, and then we have also an advisory company. So what we do is basically we provide analysis and information about the markets and the industries, mainly the financial industry, and we do a lot of work on risk management. Risk management, we have an important platform on national liability management. We work a lot on credit risk and all the Basel, let's say, issues. So validating model rating and everything about this kind of issues. We also have a platform from wealth management and, let's say, asset management decision making for the industry. But just, I don't have to sell anything to you, just to say why we are in this, in this field, and look, we have an idea about what is going on at this time with this new, in the financial industry in Europe, and after this very new wave of regulation that is changing the landscape of this industry. I'm going directly to one of the issues that we discussed in this couple of days. Yesterday we had a Dangala that is, talking about capital. So the idea of how much capital has to be in the industry, and it would be the idea to move from a risk-weighted approach to, let's say, just to have higher level of capital, and that's it. This is something that is in the debate. If we look at the situation in Europe, of course we know from 2008, 2014, also before there was the same let's say, evidence. We almost doubled the level of capital ratio from the beginning of the crisis to up to date. So one of the, and of course this increase in capital ratios has been reached by, let's say, two components. The one is the increased capital, the good capital, capital high quality, but also a reduction in risk-weighted assets, a reduction in risk, let's say, into risk. And in some countries, this has been very huge, a very important contribution to the improving capital ratios. If you take Italy, for example, you have a reduction in risk-weighted assets, very, very important. Not only due to, let's say, the changing in metrics. Okay, you move from standardized approach to internal model approach, but just reducing risk. So reducing, for example, the amount of loans that you have in the portfolio. So this is one of the main driver that has been used to improve, let's say, risk capital ratios. Of course, a lot of capital has been injected into the European banking system. And now one of the question is, and also if you, one of the question is with this extra capital, because you are well above the 7%, you are above the 8% that the ECB put in the comprehensive assessment, there is a room to take risk again and then to finance the economy and to finance growth. This is one of the main challenges that now the European banking system has. Mostly in some countries, these challenges is a very important one. So, but we now face a period of very, very high uncertainty about regulation. All the people that I speak before me, are not from the, let's say, the industry, so institution. But if you talk to banks directly, and if you talk to the industry, they are complaining a lot about these things. They're going to say, okay, look, what will be the level of capital ratio that we have to reach? There are a lot of uncertainty right now. Uncertainty about, there's a number of issues that the ECB, the SSM has taken over, and then also the EBA. So we have the removal of national discretion on the calculation of capital ratio. We have the revision of the risk weight on the standardized approach, the introduction of a floor for the IRB model. There was the revision of risk weight on operational market risk, and the revision on the government bond, maybe for the let's say the government bond, and then and also problem on deferred tax asset and TLAC and so on and so forth. These are really, really important issues that maybe during the 2015 and 2016 they're going to be solved, some of them. But they have an important impact on the willingness for the bank to take the risk and to, let's say, use their excess capital they might have today, because they don't know this is an excess capital. It might not be an excess capital. For example, we make some calculation for the Italian banks, and this is the 13 banks, actually we have 15, but we make calculation on 13 banks that are under the ECB direct supervision. And if we make an estimation about the impact of this new regulation, it's going to be around 150 to more than 200 basis points for credit risk, another 50 basis points for operational risk, about 60 basis points of sovereign risk. So if you put together this, it's almost 300 basis points. So 300 basis points is something that is made very difficult for bank now to decide to use the excess capital they seems to have today after the evaluation of the ECB, and so to take, let's say, more risk and to improve and to increase growth. So this is one of the issue, very important one, and that also, this is a very important area for the risk managers, because risk managers inside the banks, inside the institution, have to face with this kind of problem. They have to go through the internal model, and they have to change the metrics. They have to improve, and also to reduce the huge differences that are emerging during the comprehensive assessment. The number of internal models, and let's say the models, where the banks are using for measuring, for example, credit risk is very, very, very wide. So, in order to reduce these differences, there is a lot of work to do, and the effect on the final, let's say, decision of the bank in order to take more risk and to going back to finance the economy, let's say, it's very important. And also we have this process. Now in 2015, as you know, this SREP process is going on, and this is something that is not going to measure the risk and exactly how the banks are measuring the risk, but you are going to face it to understand how the banks and the individual banks have a business model sustainable on a medium long term, And this is another important, very important issue. This putting a lot of pressure on the banks and on the boards, that they have to, let's say, show to regulators how they can go back to profitability. Because this is, I think, this is the last chart that I'm going to show, that I just took to the ECB report. This is a real challenge for the banking system, European banking system, and then you see here there's a difference between the cost of equity, that is the red one, and the return on equity. And this is equity, so this gap that is very wide in Europe, and the problem is how to reduce this cost of equity. So we have to reduce in terms of reducing risk. And so this is one of the main challenges that the overall European banking system, in some countries more than in another, but and now to improve return on equity. This is not sustainable. If you go in this situation, and so you stay for a while, okay, how can you have to, and the banks have to take actions in order to close that gap. So one is, of course, reducing the risk that you have in the balance sheet, and this is not easy and it takes time. But in this way, you can see that how can you take more lending activity if you have, for example, in some countries, in some banking system, were very traditional one. So deposit and lending. How can you reduce the risk that you have in your balance sheet? Okay. Without, you should in some way take more loans on lending activity, but the lending activity is the one that now is, is increasing return risk weighted does it. Is the activity that is more, let's say, capital intensive in some way, right? So it's a very difficult challenge. And the return on equity of the banking system, the European, but there's the same from Italian. I have, this chart with also the forecast that we make for the next 3 years for the Italian banking system, and you see the same problem. How can we improve this return on equity? The return on equity is that you have to change the business model. You have less, let's say, risk in your asset side, in your balance sheet, let's say. You have to add more services and fees based activity, less lending activity, and otherwise, you need to have more capital, but more capital in order to raise this capital, you have to, let's say, have more return in the medium term. And this is the real important, let's say, challenge that overall the European banking system and in some countries more than others, for example, the Italian banking system has to face. And so, just a few words for the risk management practice, let's say. Now the risk management, internal risk management of the banks have to provide, let's say, not only like before specific measure for the individual risk, the credit risk, the market risk, the liquidity risk, the interest rate risk. This is important, of course. So all these vertical measures, but the integrated evaluation of the risk, because you have to cope with measure like and count like risk capacity, risk appetite, let's say risk tolerance, and those are all, let's say, integrated measures. So we need also more, let's say, instruments, for example, scenario-based analysis, that is very important to measure the overall dimension of this kind of risk and to put together this risk and to, at the end, reach, let's say, your the numbers or the evaluation that the banks has to decide, the board of directors has to decide in order to try to close this kind of gap. That is very, very important.
Thank you very much, Professor Zignani. And I think all these interventions, they provide some kind of rounding for the final intervention. This first on the panel from Dominique Marchand, that is working for a private consultancy, providing support and services for risk management to the hedge fund and credit fund and industry. In the past has been the head of risk for the Central Bank of Luxembourg, and is also a member of the Luxembourg Association of Risk Managers, and also we had, thanks to the support of Luxembourg for Finance, that is also this institution created by the Luxembourg government to support the financial industry into this country. As you can know, it's particularly important for Luxembourg. So I think the question for him is more, if you think about it, we've been through the general kind of credit support, equity, and Professor Rosignani provided a snapshot of the challenges that there are. And there were a lot of reference in the last 2 days about the shadow banking. So I think I'm going to ask him a bit more support to understand how the shadow banking may have a prominent role going forward, also in Europe, and how you can look at that from a risk management perspective. So I give the floor to you for your intervention.
Thank you, Cosimo. Usually talking about shadow banking raises expectations, so I hope that I will not. You will not be too disappointed. It's only me, in fact. And I would say that I represent something like the degree of freedom of the funding system that we have described in this panel session, having policymakers, public institutional investors, a description of the banking system, how it finances the real economy, how it faces difficulties in financing the real economy with some profitability. In fact, linking together the topics of investment management, financial stability and risk management may have sounded a bit weird even a decade ago. It was not the usual approach, but since then the financial crisis has taught us that all financial operators in markets are linked, whether they are banks or non-banks. And finally, financial stability concerns have spread in all fields of the financial activities. Even to the investment industry, whereas it mainly concerned the banking industry. We may even make the remark that even central banks have been, I would say, a bit long to take financial stability into considerations. Consider that the first reviews of financial stability or financial stability departments in central banks are only a few years, have only been created a few years ago. Just before the crisis, but obviously they have been significantly staffed, and their importance has increased since the financial crisis. So, in fact, it seems that with the financial crisis, central banks and policymakers have simultaneously discovered the investment industry and the importance of financial stability on top of their traditional monetary policy missions. And when I mean investment management industry, I will especially, as Cosimo explained, insist on non-credit bank, non-bank credit institutions, so-called shadow banks. An illustration is that the first memory I have from the financial crisis as a professional, in Europe at least, was BNP Paribas closing one of its money market funds, or so-called tilted money market fund in August 2008. To me, it was the early sign that something went wrong, since BNP Paribas decided that it could not face the redemptions on those money market funds, which were also invested in ABS. It was like a summary of what was going to happen in the ABS market and in the funding market. Since then, we have switched from, I would say, benign neglect of the investment industry from policymakers to significant surveillance, and investment funds have grown rather high on the agenda of regulators and policymakers, especially in Europe, but also in the US. And it is especially the case. It has been especially the case since the G20 of Pittsburgh and the Barnier declarations, Commissaire Barnier declarations. So just to list a few of those regulations aimed at regulating the investment industry, we may quote the EMIR, so the European Market Infrastructure Regulation, MiFID II, the IRMC, the Money Market Funds Directive. All those texts point to higher requirements for the risk management of investment funds. The IFMD especially has some particularly stringent requirements extending the formal requirements of having a permanent risk management function within investment funds, separate from the portfolio management. It is not to say that before risk management did not exist in investment funds, but it was strictly limited to some retail investment funds, the so-called UCITS or mutual funds. Today, with the IFMD, most of investment structures investing in securities, but also private equity funds investing in private debt or private equity of companies. Also real estate funds, global macro funds, or private debt funds in general are regulated and should have rather high standards of risk management, which is a good thing. The problem for the profession was that, well, standards of risk management do not exist. For the banking sector, the Basel frameworks has evolved from Basel to Basel III, with some major evolutions towards the use of the internal modeling. There is nothing such as this in the investment industry. The only example to be taken would come from the UCITS world, as I've mentioned. But UCITS invest mostly in public securities and bonds, and the risk monitoring is mainly focused on market risk. So it has nothing to do with the risks which are to which private equity funds, for instance, are exposed, which has more to do with operational risk, credit risk, typically. So there is a real challenge for the investment industry. And maybe the examples of risk management standards are not to be searched in the investment industry itself, maybe more on the banking side, because as you all know, investment funds are taking a larger part in the financing of the real economy with the so-called shadow banking phenomenon. So, what is exactly, it has become in fact very hard to define what is a bank and what is a non-bank credit institution. So maybe we should start on this, because we cannot say that a bank is a bank because or that a credit institution is a bank because it is regulated. Today, because similar organizations providing similar financial intermediation services, transforming maturities, managing risks, taking a short-term or medium-term funding to transform it into long-term loans can be found in both the banking and the non-banking credit institutions work. So it is not a criteria. So that's why I believe that there is something like a convergence underway between the two sorts of institutions. The Financial Stability Board has published some rather interesting papers and has started to extend the scope of its monitoring framework to shadow banks or to non-bank credit institutions. So they have no surprise that they have found the following key features and obviously key risks in the non-bank credit institutions activity. I just quote three of them. The reliance of those institutions on short-term market funding, the excessive leverage combined with the liquidity of assets held, and often with an important activity in the repo market. And finally, say some wrong or negative incentives in the way securitizations operations are packaged. Put together, those factors traditionally lead to those pro-cyclical behaviors that have been so negative during the crisis, creating incentives to generate excessive loan supply during booming economic cycles, and cutting credit when things turn wrong for companies and when they would need it, especially. So against those three risk factors of over-reliance on short-term market funding, excessive leverage, and wrong incentives in securitization, some measures have been taken. Especially for money market funds. As I told you, finally, the crisis started with money market funds, and so the first institutions to be regulated shall be money market funds, whose importance for funding in the short term in the money market is very important. Money market funds, through the dedicated directive, should especially reduce their reliance or over-reliance on external credit ratings, which we know is a source of procyclical behavior. They should increase their capital. It seems that everyone should increase its capital these days. And finally, they should turn to a more mark-to-market valuation process, suppressing constant NAV funds and promoting floating NAV for prime money market funds. besides that money market fund directive, we also have the risk management requirements stemming from the IFMD, so the Alternative Investment Fund Manager Directive, which basically impacts all alternative investment funds, meaning everything but UCITS. And the latest initiative to be mentioned is the publication of the regulation for the European long-term investment fund in May 2015, just 1 month ago. So it introduces, under the IFMD, under the Alternative Investment Fund Manager Directive, it introduces that type of fund which is aimed at providing long-term capital to infrastructure projects, especially, whose investors can be institutional investors, as usual, but also retail investors, provided that they respect the lock-in period. Obviously, those funds will be closed-ended funds. It is interesting because it somewhat creates an hybrid investment vehicle. The constraints in terms of investment restrictions on the investment policy will be, it sounds like, what you can find in the UCITS environment, with rather strong limitations on concentrations, on leverage, obligation to diversify. But it is aimed at, well, it is, maybe it sounds like a conclusion, or maybe I think that it is a common point to all the interventions we have. It is definitely aimed at conveying capital to long-term investments that are so much needed in the creates a hybrid investment vehicle. The constraints in terms of investment restrictions on the investment policy will be, it sounds like, what you can find in the UCITS environment, with rather strong limitations on concentrations, on leverage, obligation to diversify. But it is aimed at, well, it is, maybe it sounds like a conclusion, or maybe I think that it is a common point to all the interventions we have. It is definitely aimed at conveying capital to long-term investments.
So first of all, I would like to thank Cosimo for coordinating the moderation of this session, and also for coordinating the local committee, putting all the souls that are represented here together. It's true, Menachem, there are many players, but as you can see, they are very well coordinated. They sit one next to the other. I had another question for but it's too late, for the EIB and EIF. Because I mean, when I teach corporate finance, I know that risk and return are related. So the fetish about the AAA, is it really necessary in this period in which we have to speed up growth? Or maybe the EIB can give up and can decide to not be at the top of the standard of the rating, trying to really push the growth, at least for a problem of confidence that people can get out of it. But I mean, yes, just 1 second and then I will do the conclusion. Because it's something that, I mean, you know, risk... Well, it's something that many people have been asking and questioning, even in very high places in Europe. And I don't know the answer, meaning I don't know exactly, I don't know what would happen if we gave it up. I know why we, to the extent possible, do not want to give it up, because it is an element of our business model, a key element around which the business model revolves. But it is also a key element about the general idea of making an investment, I mean, having public intervention in the economy, so making an investment bankable that wouldn't otherwise be. You can do it efficiently if you are bringing creditworthiness in the market. And if you're bringing creditworthiness in the market, you are also, on the other side, bringing return. So either you are making an investment less risky, or if you want, you are making that investment more profitable, everything else being equal. That's the only way that return is interesting from the IB perspective, because of course we don't seek return. We are a non-profit institution, and the AAA is there simply to guarantee that we can fund our projects.
If I may perhaps add to that, I mean, as I said, we from our side use really very actively the AAA for specific business purposes. But I would say, I mean, AAA, what does it mean? It also means a certain level of excellence in general. And I think if you have an international financial institution, then for reputation reasons, we should be very careful to keep this rating, because it would perhaps be perceived by the market as, well, they are perhaps not so good then as they claim to be.
I agree with you, but I think also that pushing a little bit up the growth, it's an important. If you can do both, it's much better. And we go back to the very key element of risk management that are the managers, the people, no? And so this for today, to say thank you to all of you for this panel, Sergio, Francesca, Peter, Dominique, and Giuseppe, and also to all of you that, you know, there is no conference without the attendees, no? They told me when they went tried to teach me when we start this conference, that in order to have a good conference, you have to have good people to present, good people to follow up to the end, like today, and you have to have a strategy and a vision for the future. No, our future is a little bit less uncertain than it was 2 days ago. So yesterday we had a sort of conditional declaration for the next year venue that will be in Israel. This is going to take some more risk from our part, because JRC cannot probably be one of the co-organizers due to the fact that it's not in Europe yet. Good, there is no journalist. There are no journalists. But it's a challenge. I mean, we like risk. We do start risk. We are comfortable with taking risk. I'm sure we will sort out another pleasant way to be together. For the moment, it's all. I wish you a safe trip home, and thank you very much again to be here. Thank you.